There can't be a better breeding ground, if you will, for volatility than a sea change in conditions, fractured geopolitics, decreasing liquidity, and an increasingly automated trade environment featuring the excessive leverage that always comes from options. And I suspect that your listeners will have to strengthen themselves, both psychologically and financially, to deal with the volatility that I think we're much more likely than not to see over the next couple of years.
Here at Liberty in Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Welcome back to Liberty in Finance. We're always glad to have this returning guest. Rick Rule is the former CEO of Sprott Asset Management, currently the CEO of Rule Investment Media. He joins us this Monday, May 9th, 2022. Rick, thanks for coming back on Liberty in Finance.
Dunnigan, it's always a pleasure. Thank you for having me back.
The number of questions that get submitted ahead of your arrival here is always daunting to me, but I'll do my best to summarize this into some themes. The first of which plays into something that I know that we're going to be talking about, so maybe I'll first bring up that, and that is the emerging increases in market volatility, perhaps not only to the downside, but perhaps also to the upside, but basically dramatic and dizzying moves in both directions. You've got some thoughts about what can be driving that phenomenon that we're seeing and whether that is likely to maintain and perhaps even increase going forward.
That certainly tops the list of questions that I get on the rankings database too, Dunnigan. So it's a timely discussion. And I think that volatility likely increases. There's no certainties in the world, of course. One looks at probabilities. But when you look at the reasons for the volatility, I think a few themes are coming to bear. The first is that I think we're coming into a sea change around following 40 years of declining interest rates, coming back into increasing interest rates. That increase in interest rates after 40 years of declining interest rates changes the way that people invest. That leads to volatility by itself. But I think importantly too, the markets, all markets, are becoming less liquid. If you look at the trading volumes around equity markets, speculative markets, some debt markets, the markets are becoming much less liquid. And those markets where they exist are becoming increasingly driven by institutional order flows and ETFs, which means that rather than the market being comprised primarily of living, breathing, thinking human beings trading with each other, it's essentially machine against machine these days. The markets are often driven algorithmically, and increasingly the algorithms, in an attempt to generate alpha, are employing options, which is to say they are leveraging illiquidity. There can't be a better breeding ground, if you will, for volatility than a sea change in conditions, fractured geopolitics, decreasing liquidity, and an increasingly automated trade environment featuring the excessive leverage that always comes from options. Whether this is a good thing for you or a bad thing for you really depends on you. The markets are going to be what they're going to be. And I suspect that your listeners will have to strengthen themselves, both psychologically and financially, to deal with the volatility that I think we're much more likely than not to see over the next couple of years.
Now, as you and I were discussing prior to recording, volatility can cut both ways. It's strange to me as an engineer that I always think of volatility in terms of looking at any signal, and in signal processing, you're looking at amplitude versus average and that sort of thing. You're looking at wilder and more rapidly increasing and decreasing swings. It has nothing to do with just going down. But if you watch the mainstream financial press, the only days that they'll roll out the V word, is when markets go down. Is that, in your view, important for people to understand that volatility can whip both ways going forward?
I think it's critical. And you point out the obvious. people are concerned with its impact on themselves and their own narrative. The truth is that a 12% down move and a 12% up move are just as violent. It's just that people who are long believe that the up mood is justified. It isn't volatility. It's the market coming to their point of view. Whereas a 12% down view, downturn means that there's something not right with at least their universe. And people, yes, because most people are long, assume that the upside is warranted and the downside is volatility. The truth is that I think you're going to see volatility over the next couple of years in both directions. And I think that you need to be prepared to act both ways. I've said on your show before, Dunnigan, that the cure for low prices is low prices, the cure for high prices is high prices, and that you make money by being brave when others are afraid and afraid when others are brave. What volatility really is a series of opportunities to take advantage of discrepancies between price and value. If you liked the idea of a stock at $10 and the stock is suddenly at $7.50, you ought to like it more at $7.50 than you did at $10. And as a consequence of that, the downside volatility should be your friend. Similarly, if you thought that $10 was a fair price and the stock is suddenly at $12.50, you may need to reconsider the relationship between price and value, which is to say, the fact is that you should probably consider buying stocks that you like when they're cheaper and selling them when they're more expensive. It makes absolute sense, but of course, psychologically, it's very tough to do.
When you mentioned a few moments ago about people needing to be aware that it's very likely, in your view, that volatility, both to the downside and the upside, will increase going forward, that they should strengthen themselves psychologically and financially. One way that people are concerned about that volatile environment is when they're looking at their approaching retirement, their hopes for retirement. And a lot of traditional advice as people are coming into late career stage and approaching retirement is to reduce your exposure to risk and to try to do more and more conservative things so that your path becomes more predictable. But the environment that you're describing is less and less predictable potentially. There's a question specifically for this from a viewer named Think For Yourself. It says, when do you see regular folks waking up to the fact that their pension fund holds 40% of the portfolio in government bonds that are guaranteed to lose value against the rate of inflation? And when they do realize that, will those fund managers likely move into precious metals related assets?
Well, I think that's the $64 trillion question. The questioner is very observant. For the last 40 years, through a period of declining interest rate, the mantra among pension investors, long-term investors, has been approximately 60% equity, 40% debt, which worked great during the period of declining interest rates. You got capital appreciation of the bonds and the distributed value of distributions went up as competing yield products offered less and less yield. That game's over. And so your outlook must change. Imagine yourself, Dunnigan, as the manager of, say, the Stanford University Endowment. You own a U.S. 10-year Treasury. It's paying you 3%, and the purchasing power is declining by 8.5% or 9% compounded a year. What happens to your obligations to the university 15 years from now when the net present value of the purchasing power of your 10-year Treasuries has fallen by 50%? It's an ugly conundrum. And my suspicion is that you will see massive disintermediation from long and mid-term bonds, disintermediation being a fancy analyst word for selling. And I suspect that some of that money will, in fact, find its way into precious metals. It probably won't find its way into precious metals until precious metals has become a popularly accepted investment maxim again. I've said on your show before that the combined market share of precious metals and precious metals-related investments is less than 0.5% of all savings and investment assets in the United States, which is down from a 3-decade mean and median of between 1.5% and 2%. It is estimated that in 1981, at its peak, that the market share of precious metals and precious metals-related assets in U.S. savings and investment markets exceeded 6%. Now, I'm not suggesting that the interest will return to its former high. I'm merely suggesting that if you have widespread portfolio readjustments out of an asset class that's 40% of most of those portfolios, that some of it will find its way into an asset class which has traditionally been regarded as insurance against inflation. My suspicion is that if interest in precious metals and precious metals related assets were ever extraordinary enough that it exceeded its prior median mean, that the time would come for me to come on Dunnigan-Kaiser's show and say it's time to lighten up on your precious metals.
There's another theme here that's, it must be almost a fourth of the questions that were submitted are all around whether or not the silver or gold markets are free markets on the COMEX and LBMA, or whether there are other forces that are not free market forces that are affecting. Some people call it manipulation, some people call it suppression, some people call it all kinds of things. There's lots of stakeholders in that drama. Miners are certainly one, holders of stocks in mining companies are another, holders of physical precious metals are others, on and on and on. You are close to a lot of those stakeholders. What's your personal view, just in basically lumping about 20 questions together into one, of whether or not the silver and gold markets in particular are in fact freely traded markets, or is there more going on that affects the price of those metals than the free market?
First comment has to be semantic. Manipulation is part of a free market, and anybody who doesn't believe that manipulation is part of a free market is mistaken. Prohibitions against manipulation are unfree. I'm not defending manipulation. I believe that all markets in the near term are manipulated. If a market as large as the LIBOR market or the U.S. Treasury market can be manipulated, and it's been proven that they have been, obviously markets that are as constrained as the silver market are much more easy to manipulate. I am not a believer that there has been a 10-year or 20-year or 30-year effort to manipulate precious metals market prices lower. That was happening all by itself. We had a 40-year decline in inflationary expectations from 1982 to 2022, simultaneously with a 40-year period of increasing strength in the U.S. dollar and declining interest rates. Why would someone strive mightily to knock down the price of precious metals when the markets were doing it for them? That doesn't make any sense to me. But manipulation by trading desks takes place all the time. And imagine the opportunity for mischief, as an example, in the silver market, where the futures markets trade between 1 and 200 times per day the amount of silver available for good delivery to cover. Imagine, if you will, the mischief that could be caused by a desk looking at the long futures markets in silver, establishing a leveraged short position, and then engaging in an aggressive selling campaign in the spot market to lower the perception around the future. Imagine what you could do, and of course I'm making this up, Dunnigan, if you had a $2 billion short position out over 2 or 3 years in the futures market, and then you borrowed in the very short term and flooded the market with $60 or $70 million worth of silver overnight when the markets were their most illiquid. If you could lower the spot price of silver by 3% or 4% or 5%, it is not unlikely that you could lower the futures price by a like or greater amount. And if you're using 10 or 12% margin in the futures market, help yourself to a 50 or 60% gain. That type of manipulation, that type of arbitrage between stock to float and between long and short-term markets occurs all the time. And to believe that it wouldn't occur in the precious metals market is naive. I myself remember when there was aggressive manipulation in the physical gold and silver market to the upside during the decade of the 1970s, using the same shenanigans. Understand that the manipulators are traders. They don't care about the direction of a market. They care about the dimension of the move and whether or not they can cause it to occur. So yes, gold and silver markets have been manipulated from time to time to the downside for the last 40 years because it's been an easy thing to do. And my suspicion is that 2 or 3 years from now, they'll be manipulated continuously to the upside, because that's the easy thing to do.
We've been talking about gold and silver primarily. There's quite a few questions about the platinum group metals in here. Your view of the platinum group metals and their role going forward for investors?
I'm bullish on the platinum group metals with one caveat. If we suffer a global recession or depression, many people now are attracted to platinum group metals because of their relevance to a fuel cell economy or a hydrogen economy. I'm much more attracted to them for traditional reasons, which is to say, as an auto catalyst. You don't see groups of young, long-haired kids walking around with protest signs that say, more smog, more smog, more smog. The truth is that the internal combustion engine, which, although the big thinkers don't like it, will be around for another 2 decades, requires platinum and palladium as an auto catalyst. A very small amount of platinum, $125, $150, provides the clean air attributes that allow for the sale of a $50 or $60 or $70,000 car. If the price of platinum were to double, it wouldn't affect the lot price of a car at all. And so I see demand for platinum and palladium continuing to grow at the same time that supplies are threatened. Supplies are threatened for various reasons. South Africa, political instability in South Africa, labor laws in South Africa, the fact that the South African mining companies are unwilling to make large capital expenditures in the mines because they don't know who's going to own the mines 5 or 6 years from now. The fact that the dominant platinum and palladium producer by cost in the world is Russia, and the supply chain disruptions that we've seen very recently. When will all this play out? I don't know. Will all of this play out? I don't know. But the juxtaposition of risk to reward in platinum around the probabilities, both on the demand side and the supply side, make it, for me, an extremely interesting speculation. It's worthy of note, too, for an equity investor that the ability to play the game in platinum and palladium is very, very, very constrained. There are probably 2,000 companies worldwide that purport to be, at least in the precious metals business. Many, many, many fewer in the platinum and palladium business. I'm particularly attracted to small capitalization opportunities where they're available that aren't in South Africa or Zimbabwe or Russia. From my point of view, the ones that I've been able to discover have primarily been in Australia or Brazil. And laterally, because Brazil is regarded as a less attractive country to speculate in than Australia, it would seem to me that the Brazilian opportunities have been relatively cheaper than the Australian opportunities, which means that I myself have been focused on speculative PGM opportunities in Brazil.
We've got, I just realized there was one more theme back on the silver market that I forgot to touch on with you. Christopher Stewart says, I understand the futures markets, but I don't understand the silver market. I assume miners sell to refiners and refiners sell to mints and industrial users. What I don't understand is where the bullion banks come into the picture. Somewhere along the line, I assume the banks have a silver price exposure they have to hedge on the COMEX. Where do they get that exposure?
There are bullion banks that retain bullion for their own accounts or bullion to satisfy trading desks. And very often those banks do hedge their silver exposure, either long or short, depending on the position of the underlying bank in the market. That's the, if you will, legitimate use for derivatives. The off-market trading activities that the bullion banks engage in, which is to say, selling silver, as an example, to industrial users and fabricators, or selling silver to investors, is an important part of the trading and commodities desk business of some physical banks. And that's a legitimate use, in fact, for derivatives. Increasingly, what you're seeing, however, is that the non-bank bullion desks are becoming an increasingly important part of the silver business, whether those be ETFs like SLV or special purpose trading vehicles like the Sprott Physical Silver Trust, or the non-bank commodity traders, the Glencores of the world, those are important actors in the silver space. The use of futures markets is important to every facet of the silver trade, be it fabricators who need silver as an example for its reflective properties to make solar panels. The only way that those solar panel fabricators can have some sense of what it will cost them to produce a solar panel has to do with using the futures market to lock in the supply, at least of some of their silver. Simultaneously, silver miners often want some certainty in terms of revenue, as would, frankly, bankers who finance silver miners into production. At every aspect of the silver trade, there are legitimate uses for the silver futures markets. And I think that speculation, too, is an entirely defensible use. It's the speculator who provides the liquidity that allows a market to establish a reference point between other buyers and sellers who otherwise would be victimized by an extraordinarily illiquid market. So the truth is that there's a vast ecosystem around silver and around futures markets. The thing that continues to be odd to me about silver is that most silver supply in the world doesn't come from silver mines. It comes as a byproduct of base metals. And so to understand something about the dynamics of the silver market, you need to understand something about the dynamics of the copper market, the lead market, the zinc market, and the silver market. And if you combine that opacity in terms of future supply with a market that has so much volume in float relative to stock, meaning that the futures market on a daily basis can trade 200 times the amount of physical silver available to satisfy the trade, is what makes the silver market particularly prone to manipulation and also particularly volatile. As you point out, silver bulls don't seem to mind upside volatility, but they get distressed inordinately by downside volatility, and casting about for somebody to blame for that volatility, they look to very, very strange places.
We've got another question in a different resource area. Love Button asks, what does Rick think of pure play natural gas stocks at this time? Are they of value?
A value, yes. The easy money was made 2 years ago. You know, when the natural gas price went to 25 and 30 cents a million BTU, that was the easy money in natural gas. But it seems to me that the natural gas stocks in both the United States and Canada are discounting $3.50 or 4 cent natural gas in a $7.50 world. If you look at the market capitalizations of these companies relative to the net present value of their future cash flows, one would suggest that the market is discounting $4 natural gas. And I see the natural gas price going up before it goes down. So I would say that value-oriented investors should be looking in the natural gas space, both in the United States and Canada.
Rick, we always have more questions than we're going to have time to get to in this interview, but something is big and approaching that I wanted to make sure we got you a chance to talk about, and that's the upcoming Rule Symposium on Natural Resource Investing in Boca Raton, Florida in July. Can you let people know when that's going to be and what they should know about it so they can decide if they want to attend?
26th through 29th in Boca Raton, Florida. As many of your listeners know, we've been putting on live natural resource investment symposiums for many, many years. We had to cancel the practice 2 years ago as a consequence of COVID, but before that, we'd done it in Vancouver for 26 years. And they were, if I say so myself, I think the finest natural resource investment symposiums on the planet. The finest for various reasons. We've done a great job of bringing wonderful big picture analysts and gurus, the James Rickards and Daniel DiMartino Booths and the Doug Caseys, the Grant Williams to the stage, which is great. Getting that big picture background, understanding the macro around the economies in general, the political economy, but natural resource economies is important. probably more importantly, unlike other conferences, we have always had as panelists people who've built billion-dollar companies from scratch, people who are there when the rubber meets the road, not just the big thinkers, but in fact the doers. The best part of my conferences has always been the living legends, a panel that I have of people who have built multi-billion-dollar natural resource companies from scratch, talking about how the lessons that they learned can benefit investors and talking about how those lessons have made them better investors themselves. Dunnigan, I remember 4 years ago following Robert Friedland, the legendary speculator, around the floor of my own conference, at a respectable distance, of course, taking note as to which exhibitors he visited and which ones made him smile and which ones made him frown. I think for an intelligent speculator, being able to do that by itself would be worth the price of admission to the conference. Finally, investors need to know that at my conference, the only companies that are admitted as exhibitors, and it's the exhibitors where the rubber meets the road. That's where you make the money. You learn how to make the money from the speakers, but you make the money by employing those lessons on the exhibit floor. No exhibitor is permitted into my conference if we don't own that exhibitor in a Sprott managed account or in my own personal account. Now, sadly, the fact that they're included in my own personal account doesn't necessarily mean that the stock goes up. But it means that every single exhibitor is vetted. We know them well enough that we own them. At most conferences, the qualification for exhibit is a pulse and a check that cashes in reverse order of importance. At our conference, every attendee knows that every exhibitor there is owned by us, so we know them well enough that we've risked our own money. Importantly, Dunnigan, on this product, like every educational product I've ever offered, attendance comes with a full money-back guarantee. If you come to the conference in Boca Raton and don't think at the end of time that you got your money's worth, I will refund it. No questions asked.
If people want to find out more about that, folks, and if you want to sign up and support our channel as well, look in the description of this video. You'll find a link that you can use to not only register for the conference. I will be there personally, as will my sons Elijah K. Johnson and Kaiser Johnson, whom you've met on our channel on the Ask the Brokers live night, etc. And we'll be happy to talk with you when we see you. But also, we'll be attending some of those sessions that Rick talked about, and you can support our channel and our platform as well by using the link in the description of this video when you register for the conference. So look forward to seeing you there. And Rick, before we let you go, I wanted to give you one more chance if you wanted to re-up your offer to rank the portfolios of our viewers who send them to you.
I would love that. But first, too, I need to say to people that attendance at the conference is limited. Unlike a virtual conference where we can have as many people in the conference as show up, I have 500 seats for Boca Raton, and when they're gone, that's it. The recently completed virtual conference, the Uranium Boot Camp, we had budgeted for 1,000 attendees, and we ended up with 3,300. We could accommodate those. We don't have unlimited room at the Boca Hotel. I'm not saying that we're going to sell out, although I believe we will because we've always sold out before. But to the extent that you want to participate in this conference, understand that space is actually, really, factually limited. Now, as to rankings, many of your readers know that for years I have been willing to rank on a no obligations basis people's natural resource portfolios. Simply go to ruleinvestmentmedia.com, enter your natural resource stocks. Please, once again, no crypto, no tech stocks, no narcotic stocks. I don't I don't do those things. Natural resource stocks, I'll rank them 1 to 10, 1 being best, 10 being worst. If I have comments on individual issues, which I think might be interesting, I'll comment on the individual issues. If you are interested, by the way, in the private placements I'm doing with my own money, in the comment sheet, write placements. It turns out I can tell you about these things. It's not a solicitation because I'm not a broker anymore. I'm not soliciting. And further, if you care about the bank I'm building, a good old-fashioned bank, in the question and comment section, write bank. So once again, go to ruleinvestmentmedia.com. I will rank companies. I will also put you on my private placement notification list and my banking notification list if you care.
Well, Rick, we are always grateful for your presence here on Liberty and Finance, and on behalf of all of our viewers, we not only look forward to seeing you here, but I look forward to seeing you again in person at the conference in Boca Raton this July 26th through 29th.
I'm delighted to welcome you and your family. I really look forward to that. We're going to have a really good time, and hopefully we're going to make a lot of money.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.